Just keep buying. Part 6. When should you actually sell an investment? At 10 o'clock at night, Rahul had two screens open in front of him. On one was a portfolio grown over years, on the other was the last date to pay his daughter's college admission fee. If he sold today, he might lose upcoming growth. If he did not sell and the market fell, the very future he had invested for could come to a halt. He had learned only one thing for years: just keep buying. But now the hardest button of building wealth was in front of him: sell. And this time the correct answer was not in any chart. So when should an investment actually be sold? As soon as profit is visible, when loss increases, when the goal arrives, or never? This very decision decides whether money will remain only a number or become life. In the previous part, we understood the truth of buying in the midst of a crisis. A decline can be an opportunity, but only when an emergency fund, income, time horizon and diversification are protecting you. We learned that the bottom is not visible beforehand. Crisis buying does not mean making a big wager, but rather sticking to the plan through SIP, rebalancing and fixed allocation. Now the reverse part of the same story is in front of us. In buying, fear says do not buy. In selling, greed says do not sell now, maybe you will get even more than this tomorrow. The name of Nick Maggiulli's book is Just Keep Buying, not Never Sell. The purpose of investing is not always to accumulate assets, it is also to convert them into gold, security and life one day. Correct selling does not start from any market prediction. It starts from three things: your risk changed, the reason for the investment changed, or the time for the need for money arrived. Contrary to this, only headlines, an expert's target or a single day's decline are not strong reasons to sell. Emotion often makes short-term noise look like a permanent change. Practically, three big reasons for selling can be understood: rebalancing the portfolio, reducing a concentrated or weak position, and withdrawing money for your real financial goals. But these are no rigid universal formulas. Taxes, product rules, goals, health, income, and the family situation can change the decision. Therefore, a SEBI-registered investment advisor can be useful in big decisions. First, understand rebalancing. While starting an investment, you choose a target mix of stocks, bonds, cash or other assets, so that there is a balance between expected growth and tolerable risk. With time, different assets grow at different speeds. Therefore, even without trading, a portfolio can move away from its target and can become more aggressive or conservative without your thought. Suppose for illustration you chose a mix of 60% stocks and 40% bonds. This is only an example, not the correct allocation for every age and every goal. If stocks grow rapidly, their share can gradually dominate the portfolio. The return will look good, but in the next decline, the loss can be bigger than your original risk capacity. Vanguard's research says an essential thing: the main purpose of rebalancing is not to maximize returns, but to manage risk and emotion within pre-decided limits. Therefore, a portfolio that never rebalances can earn more in some periods because the winner asset keeps growing. But along with that, volatility and exposure to big losses also increase. To rebalance, looking at the portfolio every day is absolutely not necessary. A calendar-based review, action at a fixed threshold of allocation, or a combination of both can be used. No single frequency has proven best for every investor. An annual review can be simple, while a threshold rule makes one take action on a large drift. The essential thing is consistency. Rebalancing very frequently can increase brokerage, exit load, tax and decision fatigue. Tolerating a small drift is sometimes more practical than trading on every movement. In the accumulation stage, new money can be used before selling. Put fresh contributions, dividends or interest into that asset whose share has gone below the target. Here correct calculation is necessary. In a 70/30 portfolio, just buying bonds worth 10% of the total amount does not automatically make it 60/40. The required amount will depend on existing values. If money has to be withdrawn from the portfolio, then making a withdrawal from the overweight asset can also help in rebalancing. This fulfills the goal and can reduce unnecessary double trading. In a small portfolio, returning balance through contributions can be easy. Once the portfolio becomes large or income reduces, only a new purchase is not sufficient. Selling some assets can be necessary. Sometimes the old target itself becomes wrong. On retirement coming close, buying a new house, health changing or dependence increasing, the plan should be remade instead of returning allocation to the old ratio. Before selling, look at tax, exit load, lock-in, settlement and product rules. The profit visible on the app and the after-tax amount received in the bank account cannot be the same. In India, capital gains rules can be different according to the asset, holding period and product, and they change with time. Therefore, taking a decision on the tax rate of an old video is not appropriate. Tax loss harvesting can be useful in some situations, but saving tax is not the sole investment thesis. Keeping a bad asset only for deduction can also create an opportunity cost. Now let's come to the second reason, a concentrated position. Sometimes due to employee stock, ESOPs, inheritance, or a successful old pick, a large part of your wealth accumulates in one company. For an employee, the risk is even deeper. If salary, bonus, career and portfolio depend on the same company, then one problem of the business can hurt both income and savings. A familiar company feels safe because you know its products and people. But familiarity is not diversification. Inside acquaintance is no guarantee of future share returns. The claim that an individual stock will always underperform the index is wrong. Some stocks go far ahead, but choosing winners beforehand is difficult, and the loss of concentration can be extremely big. There is no fixed percentage of how much part of such a holding should be sold. The decision should be based on the goal, tax, liquidity, remaining assets, job dependence and the capacity to tolerate loss. For someone, diversifying a big portion immediately can be correct. For someone, selling slowly on a fixed schedule. Never sell fully or sell everything today. Both universal pieces of advice are wrong. A written rule can help. What will be the maximum limit of the position, by which date will it reduce, and where will the money go after the sale? Otherwise, the price can make the plan change every day. Selling company stock to pay off a mortgage can reduce fixed interest costs, but can also reduce liquidity. The correct choice will depend on the loan rate, emergency reserve, tax and your goals. While making a decision, do not look only at the potential upside. A comparison should be made keeping after-tax proceeds, portfolio risk, future income, and the alternative use of that money together. Now let's talk about a losing position. An investment appearing in red is not in itself a sell signal, because the market price can fall while the long-term thesis is still correct. But only waiting for the purchase price to return is also no logic. The market does not care about your cost. The question is, if there were cash today, would you buy that same investment again? If the business thesis is broken, governance is suspect, debt is unbearable or the fund has changed from its stated mandate, then exiting by accepting the loss can be wise. Contrary to this, the falling of a broad diversified index in a crisis is not alone a thesis breaking. Like Part 5, it is necessary to understand a price decline and a permanent loss of productive assets separately. The reason to sell a fund can be continuously poor tracking, increasing cost, a scheme shutting down or a wrong match with the goal. Just lagging behind the benchmark for 1 year is not sufficient proof. Buying the past winner and selling the recent loser is called performance chasing. Often the investor switches at that time when the old rise has been included in the price and disappointment elsewhere. Opportunity cost is connected with every holding. The question of sell is not only will there be a loss, but also, can the same money work in a place more suitable for my goal? Now the third and most human reason, financial need. Selling an investment for children's education, a house, medical treatment, retirement or a dream seen for years is not a defeat of the strategy, it is its destination. Rahul had made the portfolio to pay his daughter's fees. Selling units on that day did not mean stopping compounding, it was converting compounding into that purpose for which it was started. In retirement, selling is often not a one-time event. A sustainable cash flow is made looking at planned withdrawals, pension, other income and portfolio growth together. In the initial retirement years, a big market decline and continuous withdrawals can give a deep loss to the portfolio. Therefore, the sequence of returns risk understood in Part-5 is important in the selling plan too. Keeping cash or a suitable fixed income buffer for near expenses can reduce the compulsion to sell fallen equity for every bill. The correct size depends on the person's need. Usually, it is not necessary to sell the entire portfolio all at once. Upon withdrawing slowly according to the goal, the remaining assets can stay invested, but this too is no universal rule. In economics, diminishing marginal utility shows that the benefit received from every extra rupee does not remain identical to the first rupee. After a limit, the use of wealth can be more meaningful than its accumulation. This does not mean that some fixed wealth level gives a guarantee of happiness. It is not so. Family, health, security and desires are different. Therefore, another person's number should not become your goal. Money can make treatment easy, can give opportunities to children, can give time and meaningful experiences. But unplanned luxury spending can weaken future security. Wisdom is that today's happiness and the future self both get a share, Neither is every desire to be postponed, nor is spending to be opened without a limit seeing a growing portfolio. Some wealth can be kept for family, charity, or the next generation too. Nomination, a will and estate planning can clarify the process of passing assets to the intended people. Now let's look back at this entire journey once. Part 1 told that investing is a way to make a financial bridge between the future, inflation, and decreasing working time. Part 2 explained the different roles of stocks, bonds, property, and REITs. No asset is perfect. Diversification is not a guarantee of returns, but it can limit the blow of one mistake. Part 3 showed the difficulty of individual stock picking. Some stocks beat the index, but identifying rare winners beforehand is difficult. Broad funds can reduce that selection risk. Part 4 taught that holding back available long-term money for an uncertain perfect day can create an opportunity cost. The choice of lump sum and SIP depends on the situation and behavior. Part 5 taught saving financial safety rather than trying to be a hero in a crisis. Without emergency cash, diversification, and SIP and rebalancing, crash buying can become more of a danger than an opportunity. And this final part completed the circle. Sell when risk has to be balanced, concentration or a broken thesis has to be reduced, or money has to be guided to its pre-decided life goal. We do not have a future-telling genie, and no strategy wins every time. Yet goals, low costs, diversification, time and discipline together can make a system stronger than prediction. Rahul sold only as many units as were necessary for the fee. The remaining portfolio stayed invested. The next morning the number on the screen was smaller, but his daughter's future was bigger than before. This is the whole story of just keep buying, earn, save, keep buying wisely, and when life calls, sell the correct amount without guilt and truly live that wealth. An investor built great wealth over years.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.